Big tech rebounding today. Microsoft, Amazon, Alphabet, Apple, there you go, all surging to put the NASDAQ 100 on track for its best day since the end of August. So is this the resumption of the tech-led bull run or just a relief rally? The Dean of Valuation, Aswath Damodaran of the NYU Stern School of Business, is here to break it all down. Professor, welcome back. It's good to see you.
Thank you for having me.
I'm glad we led into this segment the way we did, talking about technology. I'm not sure if you heard the conversation that I just had with Sebastian Page of T. Rowe, who says, tech valuations are just too rich. Now, how would you address that?
You know what? One of the terms I used to describe what's happening in the market today is one of my favorite movies, Groundhog Day. I wager that if you took the show on January 3rd of this year, you blanked out the screen behind you, you'd be having exactly the same kind of conversation you had just a few minutes ago. It's almost like it's a rehash of the same argument over and over and over again. And at some point, you got to ask, is there something original that we can add to the discussion? The truth is, at the start of the year, it was about inflation and the economy. Truth is, right now, it's about inflation and the economy. At the start of the year, tech had had a bad year, and then it rebounded. And through the course of the year, it's carried the market upwards. So I think that while it's easy to look at the pricing and say, this is the peak, I'm not getting in. I mean, I own 5 of those 7 winning stocks that have carried the market, and I thank the stars for that I have them in my portfolio. I just got lucky. I can't imagine being an active investor without any of those stocks trying to beat this market right now. It's almost impossible to do.
But in a sense, Professor, it is different, at least as it relates to tech. And let's really drill down there, because at the beginning of the year, we were coming off a miserable year for technology stocks. Many on the street were mispositioned, right, for the run that we're about to have, which was fueled almost entirely by the hype over AI. So whereas now we've traveled a good road from much lower valuations. Now, we're a little bit off the peak of where we were 6 to 8 weeks ago, but we're still higher substantially than where we were. And in many cases, we're higher almost across the board for 10-year historical averages for those same stocks that I'm talking about. So that is different. That's why it begs the question now about that space in particular, which has carried us to even have this positive market conversation.
I'd push back on the AI story. I know for Microsoft and NVIDIA, AI has been a big part of what's caused the price to go up. For the other 5 companies in this group, though, the reason I think their pricing is up is because they've shown incredible pricing power. And one of the big questions we had coming into inflation is, are these tech companies going to be able to deal with inflation and pass it through? And the resounding answer we've got over the last 18 months is they have more pricing power than the traditional consumer product companies or brand name companies. So part of what you're seeing in this run-up is the recognition that these companies are much better at handling both inflation and economic potential shocks than we thought they would coming into this. And I'm not saying it explains away everything that we've seen here, but it explains, I think, a significant component of the rise in pricing you've seen in these companies.
So let's talk about Apple specifically, because it was, certainly one of the stocks of the week. I think it's fair to say you just don't see a downgrade of it as very often. And we did get one this week. And one of the, premises of the piece was we're at peak multiples for Apple. Now, again, that's one of those stocks that was, I think it was like 31, 32 times. So it's backed off that a bit, but it's still well ahead of its 10-year historical average. So how would we address that? Do you agree with a downgrade like that, which was certainly based on other fundamental aspects as well?
You know what? I'd be more worried if there were 7 upgrades in the last week than downgrades. I mean, historically, the best contraindicator for a stock is what analysts think about it. So if you get these upgrades coming out, you almost have to stop and ask, what am I missing here? What's the downside I'm missing that's causing analysts to kind of jump onto the bandwagon? So maybe it's a good thing that you're getting some downgrades here, some realism in expectations, because I think that the company's fundamentals are driven. It's an iPhone company. I mean, you can dress this up as much as you want. It's got a services business on the side. This is a smartphone company. My risk with Apple is you live from upgrade to upgrade, iPhone 15 to the iPhone 16 to the iPhone 17. That is potentially the biggest risk in this company, is the next upgrade is not going to catch on. I don't see the company giving up a big chunk of its earnings, even in a down economy or if inflation goes up. So from that perspective, with all the ups and downs, I think there'll be more ups than downs during the course of the year. So if you have it in your portfolio, hold on to it. If you don't have it, wait for a correction somewhere along the way and try to buy it. Because I think it's become the equivalent of what Warren Buffett would have called a company for all seasons, is essentially being able to deliver results no matter what.